Welcome everyone. Today I'm here with Hayden Cuff, who is a manager at Wilson Pateras, and we're here to talk about one of the most interesting topics in tax, rental properties. So Hayden, how are you?
Good, thanks Mark, how are you?
Fantastic. So what can you tell us about rental properties?
Well, rental properties are really interesting. We find a lot of Australians have a fascination with property, and as a result of that, there are a lot of people out there who have rental properties which they obviously need to account for when they prepare their tax returns come year end.
What are the most common rental property deductions that people can claim?
So we've got our council rates, our body corporate fees, our land tax, repairs and maintenance costs, interest, any kind of capital items that you purchase during the year, they're all deductible expenses.
So what about travel expenses? Say I've got a property interstate, can I claim the airfares to see that property to inspect it, say, once every 6 months?
Yes, most definitely. So any form of travel that you incur to actually go inspect your property is tax deductible, but we're just got to make sure that if you are travelling interstate, that we are apportioning for your time when it's your private use.
Okay, so if you're there for 1 week and you see a property just only takes 1 day, you really apportion your costs over that 1/7 type of period?
Yes, most definitely.
And what about if I've got a rental property in the next suburb? Can I claim the travel cost to there using my car?
Yes, you can. So the ATO allow you to use a rate based on the size of your vehicle, and all you have to do is actually estimate the kilometres between your two properties, and you can claim a tax deduction for that.
So in relation to, say, newer type of properties, I mean properties that were built after 1987 or homes that have substantial renovations to it, are there anything that we can do for clients or advise clients to maximise their tax deductions?
Yes, most definitely. So we always encourage our clients to go see a quantity surveyor. So they're the only people who can legally provide a tax deduction summary, which allows you to claim a tax deduction every year. So a lot of these items are going in and inspecting their, could be air conditioning, could be dishwashers, and it could be also fixed items, so like cupboards and items like that. We do find that by purchasing a quantity surveyor report, it allows you to claim a deduction not just for 1 year, but for every year over the life of those assets.
That's right. The benefit about a quantity surveyor report is that it is tax deductible as well. So if it costs you $1,000 to get that report done, you're going to get that back after tax anyway.
Yeah, most definitely.
In relation to repairs and maintenance, it's always a very contentious issue. Do you claim the cost of the repair, or do you claim that as part of depreciation, or is it a capital cost? Say, for example, a client had an air conditioner that just broke down and they have to replace it. Is that capital or is that a repair?
So in that particular instance, it'll be more a repair. So when we're classifying between the repair and the capital items, we need to look at what you've actually done to the item. So anything to just repair the item or repair a component of it is a repair, which is fully tax deductible. But if we were to go and incur something that's actually improved the item or fully replaced the item, then that will most likely be more of a capital item, and they'll be subject to different provisions.
Okay, so in relation to holiday homes, that's another contentious issue as well, because a lot of people will have holiday homes. They might rent it during the holiday periods like Christmas, Easter, even school holidays, because those rentals during that holiday periods can be quite high. How would you go about actually claiming rental deductions for those in that situation?
Yes, Mark. So with rental properties, all your costs you incur, they are deductible, but we do need to look at the portion of the expense that was in relation to the period when the property was rented or when it was made available for rent. So what we need clients to do is actually identify those periods, as well as have identified the periods where they used it privately.
One final question for you, Hayden. In the situation where a client is seconded to work overseas and they leave their home for 2 or 3 years and they decide to rent out their family home while they're gone, can they claim any expenses in relation to that home in that period where they're not in Australia?
Yes, most definitely. So it's all the normal expenses that they incur, a bit like a rental property, are tax deductible for them.
Okay, does that mean because that home is now a rental property, is that home, when it is eventually sold, is that subject to capital gains tax?
Yes, most definitely. So you are exposed there from a capital tax perspective, but the good thing is there's a 6-year exemption rule. So what that means is if you rented your property out for 3 years, then moved back into it, you've then re-triggered the 6-year rule. So you have another 6 years before that property will become taxable.
Okay, thanks for your time today, Hayden. So I hope you got a lot out of that video today. It is very topical, close to 30 June. And if you've got any concerns or any questions about rental property deductions, please contact your Wilson Pateras advisor.